had indicated, and we are, bound by that intellectual reasoning, that we would approach the assessment using 3 key criteria: inflation outlook, underlying inflation, strength of the transmission of monetary policy. As I said earlier on the third criteria, there is no question in anybody's mind around the governing council table, if you want to sort of propel yourself into that room. There was shared analysis of that, with little variations at the margin. On the first item, which is the inflation outlook, well, we looked at the projections that were given to us by ECB staff. We looked at experts' reading and analytical work. And when you look at the projection, you see that, I was going to say, notwithstanding the GDP revision, we have a revision upward of headline inflation in both 23 and 24, and a 0.1 revision downward for 25, which is hallowed with uncertainty, because the further out you go into the projection, the less certain it is. On the core inflation, which we look at as well, not only one, but we also look at core inflation. Core inflation is maintained in 23 and revised by 0.1 in 24 and 25. But overall, we are not at target in 25 on headline inflation. We are almost on target on core, and we only hit around 2% in the fourth quarter of 25. So when we look at that, we ask ourselves, okay, inflation outlook, how does that compare with our commitments and our target? Not there yet. And as I said, it's the key sentence in that monetary policy statement. Under current assessment, with this decision of 25 basis points hike, we believe that we are making a substantial contribution to blah, 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 blah. I will not annoy you with repeating yet again. So those are the elements that we take into account. And then the real purpose of what we're doing here is not to be found in that sentence. It's somewhere else in the beginning of the document that you have, where we say, I hope I can find it for you right away. It's in the first paragraph, where we say, in order to reinforce progress towards our target, the Governing Council today decided to raise the 3 key ECB interest rates by 25 basis points. We want to reinforce progress. We want to be as timely as is possible. And by doing that, we support our projections with a higher degree of confidence. And I think it will reinforce progress towards target. So we are determined to get there to that 2%. And we see that as the best way to accelerate the process. And by the way, it also reinforces the anchoring of inflation expectations, which are broadly at 2, but which warrant monitoring.
On how much of a drag is the property market for the financial system? Well, I will follow what the President has indicated before. I think that we have 2 different situations. In the case of the residential market, what we have started to see is that there is a slowdown in the evolution of prices in residential property, whereas in the case of the commercial property, commercial real estate, the situation is different, because we identified a decline in prices even before the tightening cycle of monetary policy. This was related to the situation of COVID, teleworking, and this kind of things. We have made a lot of analysis about the potential impact that commercial property might have in the financial system, and we have identified some channels, some links between commercial property, commercial real estate, and mutual funds that would reinforce the comment that I have made before about non-banks as a potential source of vulnerabilities for the financial system. I think that this is the element that we are trying to analyze. There are real estate funds, property funds, that have a lot of investments, and a lot of great exposure to the commercial property. And this is something that we have to look at and monitor very closely.
Thank you. And the next question goes to Silvia Berzoni of the Italian TV channel Class TV.
Thank you very much. Good afternoon, President.
Good afternoon.
So, given
Buongiorno.
the sharp...
Buongiorno.
Buongiorno. So, given the sharp downward revision to GDP in 2024, which you have already explained, but can you give us a sense of how concerned is the Governing Council about the chance of a recession, and especially in places and countries like Italy, where most, if not all, the economic activity depends on banks?
Well, I think it's in all countries that economic activity depends on financing. So in Europe, it's largely banks, but it's not something that is, peculiar to Italy. Banks in Europe play a critical role in financing the economic activity, both for corporates and for households. We are going through a phase of very sluggish growth. We move from 0 to 0.1 to 0, revised 0.1, revised 0.1, and we see also very weak signs, whether you look at PMI, whether you look at the gap between manufacturing and services that is now being reduced. We are clearly in a period of slow and sluggish growth. But as I said, the revision that we're making for next year, where we're moving from 1.5 to 1% of growth, is for 3/4 of that revision attributable to the sluggish growth that we are going through at the moment. So the difficult times are now. And the recovery that we had anticipated is pushed out into 24. And when you look at the September projection that we have on a quarter-by-quarter basis, it is the same as the one that we had in June, which shows that we are confident that growth will pick up in 24. Now, of course, we need to succeed. We need to bring inflation down, and wages have to be sustained, and labor has to hold. Those are some of the assumptions that we make in that respect.
Thank you. And the last question goes today to our online participant, Mark Boinderman of the Dutch daily NRC Handelsblad. Mark, please.
Thank you very much. President Lagarde, you alluded to the risk of food inflation picking up because of adverse weather conditions related to climate change. I know this happened in 22 already. Have you got concrete indications that this is happening again, and this could in fact impact the inflation number? And related to that, my second question is, has the ECB made any progress in thinking about how to make its operations aligned with the Paris Agreement in times of monetary tightening still? Thank you.
Sure, thank you very much. On the first one, as I said, the food inflation has come down, but it is still at 10% at the moment. So it is still hard for people, because food is obviously a component of the basket which matters a lot, and which matters more for those who earn less. We know that for a fact. So we hope that food will continue to go down, but it's one of the components that is still very high. Maybe I would enlarge your question to the price of commodities in general, because we are seeing movements, whether it is on grains, whether it is on and obviously the Black Sea Agreement denunciation by Russia is flying in the face of stability, if anything. But whether it's grain, whether it's oil, whether it's gas, we're looking at all those components very, very carefully, because some of them are volatile, some of them are on the way up, and they will have consequences on prices. I think we will have to assess on a projection by projection basis to really appreciate what impact it has in view of activity around the world as well. You know, we had a good scenario analysis produced by staff about China and the role that China growth or deceleration of growth would have on our own GDP and our inflation. That, combined with the price of oil, is obviously something that we need to be attentive to. On the compliance with the Paris Agreement, as you know, because of the tilting program that we have put in place since last October, that we have improved and modified, we can tell you very seriously that until the end of 23, we are Paris compliant. What I can also tell you is that we need to look at other measures and more measures in order to make sure going forward that we will remain Paris compliant, given the fact that we are gradually we have phased out any reinvestment under the APP, and under the PEP, the volume of corporate bonds is extremely limited. So we will be looking at that, and there will be work done by staff to propose options in order to remain Paris compliant. Thank you.
Thank you. That's all for today. The next press conference is on 26 October after the External Governing Council.
We'll see you then. A split decision at the ECB leading to a 25 basis point rate hike. That was ECB President Christine Lagarde in Frankfurt, Germany. This is Bloomberg's The Open. I'm Jonathan Ferro. And here's your market 10 minutes into the session stateside. Equities up by 0.5% on the S&P 500. On the Nasdaq drifting higher as well. Some outperformance on the Russell. A ton of US data we need to talk about. Over in Europe, in the bond market, yields lower. A bond market rally. The 2-year in Germany down by about a basis point. On the 10-year down about 6. In the FX market off the back of that, the euro a whole lot weaker against the stronger dollar. A break of 107, 106.82. We're negative there by 0.5%. President Lagarde did not want to commit to a pause, but there was a strong suggestion the ECB is doing just that.
Based on our current assessment, we consider that the key ECB interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to our target.
Let's get over to Frankfurt, Germany with Maria today. Maria, what stood out for you?
Well, Jonathan, as you say, it is a rate hike. It was interesting to hear from the head of the ECB say, I don't want you to think the debate was antagonistic, but it was obviously not a consensus decision. And then she pointed to the solid majority. To me, I thought it was very interesting going into this meeting, as you say. The market really picked up on this line, which said, of course, if you have interest rates at a, quote, sufficiently long level for a sufficient duration, you could have a substantial contribution to a timely return to inflation to the 2% that was seen potentially as maybe this is it. Having said that, and again, this really stood out to me, she was given 2 opportunities to put this debate to rest. Is this the final hike from the European Central Bank? One, she was asked directly, is this the end of it? And she cited a theater play where she says, well, a door can be open or closed, but that is a theater play and this is life. And then secondly, she was asked, have we reached that peak level when it comes to rates? And she said the European Central Bank could not determine that. So to me, that was striking that perhaps given that opportunity to perhaps settle this debate, she did not. Again, she also said from now on, this emphasis on the data dependency continues to stay. The central bank obviously has to deal with inflation. We know there were changes made to both the forecast that would point to higher inflation and lower growth. She was asked about stagflation. She was asked about recession. But obviously, at this point, this was not ahead of the European Central Bank that wanted to talk too much down the economy, but also clearly signal that, of course, the downside risks are obvious and they're palpable for this economy.
The theatre is supposed to be entertaining. There was certainly nothing entertaining about that news conference. Maria, thank you. Joining us now is Invesco's Alessio De Longis, Winnie Caesar of Credit Sites. Winnie, you were looking for a rate hike. We got a rate hike. What's next?
So I think that now you do have to have a base case of potentially a pause. We had anticipated another rate hike after this. When you look at Eurozone inflation, it is still objectively too high, even on a 3-month annualized basis, well over 3% if you average things out. And even though the economy is slowing, and as Lagarde pointed out, we're kind of in the midst of that now. Those inflation levels really do need to continue to come down. So I would say a base case of a pause, but we do think that another hike is within the realm of possibility.
Alessio, a strong suggestion will get a pause. She read this one quote in the statement about 5 times. No harm to read it once again. The Governing Council considers the key ECB interest rate have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to target. Alessio, did that statement sound like a pause to you?
It's meant to suggest a pause, but I think she did the right thing in not committing to it. While my base case is that rates are going to stay here over the next 6 months, that's my base case, but I do think that the risks, if anything, are tilted towards another rate hike, not towards an immediate cut in the next 6 or even 12 months. Yes, the economy is weakening, but it was a split decision, it was a debate, but if you really look at an unequivocal interpretation of the mandate, you can't raise your inflation forecast for every single year of the horizon down to 2025 and not raise interest rates. And I think given what commodity prices are doing, what food prices are doing, and you alluded to it, the strength that we're still seeing in the U.S. economic data, which we know will tend to lead, as they've done in this cycle, also European data, the risks are tilted that this cycle is not done.
Let's talk about that strength in the US data. 14 minutes into the session, equities are higher here. Mike McKee, upside surprise on US retail sales.
However, John, we had some revisions to July that make the news not quite as good, but it does show the consumer hanging in there. Now, remember, retail sales are calculated by dollar volume, so no surprise we saw a big rise in gasoline stations, up 5.2%. We'll talk more about that in a second. But the rest kind of looks like back to school. Clothing store sales strong, electronics store sales strong. Interesting thing, real weakness in furniture stores. We have seen problems in the real estate business, so that probably accounts for that. Something like 5 out of the last 6 months we've seen declines at furniture stores. Now, let's make something out of the gasoline story here. The question that everybody's going to ask is, how's this going to affect us going forward? And as you can see, until the pandemic, gasoline sales and non-gasoline sales, gasoline prices, non-gasoline sales sort of went together. Then all of a sudden we started spending a lot on both, and you can see the yellow lines there basically point to the times when gasoline prices rose a little bit and we saw retail sales ex-gas fall a little bit, or at least flatten out. But that's not what's happening on the far right-hand side. How long are we going to see gasoline prices going up without retail sales being affected? That is going to be the key question for the Fed in terms of how the economy is hanging in there. Other numbers out today, PPI does go up. It's an oil price story as well. 60% of the rise in goods prices during the month attributable to oil, according to the government. Initial jobless claims barely moving, and continuing claims, they only go up by 4,000. So at this point, the labor market remains strong. Americans are still spending money, but gasoline looms as a black cloud on the horizon.
Mike McKee, thank you, sir. Energy a feature of the conversation of the ECB in a higher inflation outlook. Mike McKee nailed it there as well. Brent crude 93, WTI 89. Alessio, you like stocks, you like risk, you like equities over bonds. You think Goldilocks, and that theme is here to stay into year end. Do you think this move here in crude could disrupt that?
This move in crude at the moment, I think, is actually validating that to some extent. You're not expected to see rising commodity prices when overall global economic activity is that weak. I think commodity prices tend to be more of a, especially energy, more of a coincident indicator of growth, while stocks tend to lead. So commodity prices here are validating a little bit of the move. Now, is that the perfect Goldilocks scenario? Well, not so much if you remain on the verge of raising interest rates at every meeting. But if it's actually eliminating the spectrum of the imminent recession, I think for risk assets, credit, and stocks at this stage, the ability to lower the probability of a recession further out into the future is essential, and that's what's supportive of risk here.
Winnie, is $93 Brent reflection of good things or a recipe for bad things?
I think that I would thread the needle a bit there. You know, we do have to consider what has driven crude over the past week or so, and that has been a reiteration of supply cuts. And we have to look through that a little bit in terms of central bank policy, as the Fed and other central banks are cognizant of commodity price increases, but not necessarily trying to manage their inflation mandate to those headline moves. I think that there's some mixed factors here. Heading into the fall, we had anticipated the consumer to start to slow down. There are a number of different factors, from student loan repayments to that drawdown of excess savings. It is encouraging to see that commodity prices are remaining stable, but they're also quite negative for the consumer more broadly, as you see that increase in energy prices pushing away from the ability to have incremental discretionary spend. So I think it's a little bit more of a nuanced and mixed picture rather than just commodity prices, energy prices higher equals good economy.
Commodity prices are up, the labour market's still tight, unit labour costs might be climbing as well, particularly in Detroit. It's going to be a fascinating day today. The data's behind us, US retail sales, jobless claims, a central bank decision behind us as well. In front of us, a big deadline for a deal between the UAW and Detroit's Big Three. The deal nowhere in sight, with less than 15 hours until the deadline. AMH joins us from DC for more. Morning, Anne-Marie.
Good morning, Jonathan, and that's right. We do not have a deal just yet, and come 11:59 p.m. this evening, that contract ends. And what we heard from Shawn Fain yesterday, the head of the UAW, really in his clearest signal yet, saying that there will be strikes, and unprecedented at all three of these big auto companies, Stellantis, Ford, and GM. Just they're going to be targeting specific plants, Jonathan. This puts the president in a very difficult position. We have seen a number of labor issues come to him in the Oval Office. What the president likes to do is be out front and with the rhetoric, supporting labor unions. He claims he's the most pro-union president in history. At the same time, behind the scenes, we do know that the president would like to stop a strike. This is usually how he's operated, whether it was the ports or the freight railroad unions, Jonathan. We do know that a number of individuals in the White House are tasked to deal with this. Gene Sperling is the liaison. We know that Julie Su, the acting labor secretary, is monitoring it. And we heard from Jared Bernstein yesterday, his chief economist. He said they are encouraging everyone to stay at the table. Jonathan, as a president, it's not just an issue for today. This could potentially mean the president losing blue-collar workers that could vote for him next November.
Big story for us today, tonight, and tomorrow. AMH in Washington, thank you. This is what's on the table right now. UAW, big union, wants a 36% raise. This is the offer, according to President Fain. Ford proposed 20% raises over 4 years. GM offered 18%. Stellantis 17.5%. Winnie, a question that's dominated this program now for the best part of 2 weeks. Do you see this as the dying embers of a hot labour market, or something we've got to live with for the next few years?
Well, I think that there are definitely a lot of real problems in terms of labor supply that are probably going to keep labor markets tighter for longer than a lot of people anticipated heading into the pandemic and the kind of erosion in participation. Now, that being said, recent economic data and recent payrolls data have actually shown some upticks in terms of labor participation. So I'm not necessarily convinced that this is kind of the dying embers of a hot labor market, but I do think that we are starting to reach an inflection point that should put the labor market into a little bit more of a balanced state.
Alessio, what does this mean for the viability, sustainability of some of these industries? I'm not just thinking about autos, I'm thinking about airlines as well. Do you think really they can pass on these costs to consumers, or ultimately they've got to eat this and margins are getting hit?
I think margins will eventually have to suffer here. I think the point that was made on the rising labor participation and some of the relaxation on the costs will be more evident over time. The increases in the labor participation rate are quite meaningful, and they're not only indicative of better supply, but also overall optimism among consumers. But ultimately, I think that it will not be possible to keep passing costs on to low-end prices this way, and margins will have to take a hit. While bullish, as we said, on the overall economic picture, margins are still wide, and given how tight labor markets are, and we are towards the end of the cycle, a compression in profit margins is the longer path ahead.
Alessio, thank you, sir. Alessio De Longis and Winnie Caesar on three important stories there. The ECB, the latest data out of the United States, and that negotiation between UAW and Detroit's big manufacturers, the big auto manufacturers. Your market right now looks like this. 23 minutes into the session, equity's doing okay, up by 0.4% on the S&P 500, higher here by 0.2 on the Nasdaq 100, and some outperformance there on a Russell. From New York, your trading diary up next. 25 minutes into the session, stocks just about positive across the board here. The equity market on the S&P just about positive by 0.4%. That's the price action. Let's take a sneak peek of the calendar the week ahead. President Biden discussing Bidenomics at 2:45 Eastern. At midnight, the UAW strike deadline. Next week on Tuesday, President Biden in New York for the UN General Assembly. Wednesday, we get a Fed rate decision and Chairman Powell news conference. On Thursday, another round of jobless claims and existing home sales. The data so far this week, so far so good stateside. Let's see if that changes. From New York, that is it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
about that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, September 14th. Here are the top market stories that we're following for you at this hour. The dovish hike. ECB hikes one more time, takes rates to 4% and sees inflation higher for longer. No bonds, yes to cash. Ray Dalio warns that yields will go higher with more government borrowing and opts for cash short term instead. And arms test. The company prices at 51. We're going to get the latest on the trade and what success actually looks like. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, and here's some unwelcome news for central bankers around the world. WTI just hit 90. We're off that high, but this is the highest level since November of 2022.
So I think this is having an impact on both sides of the Atlantic. You look at the retail sales numbers out of the United States, clearly driven by what is happening with the oil price right now. The question is how much longer, and Mike was talking about this earlier, Mike McKee, how much longer can the consumer keep going? How much longer, if oil stays where it is, does that ripple into the rest of the retail sector and hit spending elsewhere? And then you look at the ECB. Maybe the ECB was pushed into one last hike because energy costs are rising once again.
Yeah, but you know, Ellen Zentner of Morgan Stanley had a note out yesterday that talked like it takes a long time for that filter through of oil prices to actually affect the underlying inflation figure, particularly core. So I feel like we have to see 90 for a while for that to be the case. And I get it. You could read into the retail sales number, but final demand was still solid. Like it's solid, even if you take out the oil price increase.
Absolutely, but you look at what has happened with gasoline stations, those numbers were super strong. That clearly is an impact of the higher oil prices. You get the feed through more quickly in the United States. Here, gasoline is taxed quite heavily, therefore to a certain extent you're insulated from some of these price swings. But nevertheless, you go and fill up the car at the moment, it is super expensive. It's a tax at some point, and it feels like with the consumer stretched as it is right now, then it may be more of a tax right now. It's going to hurt right now. Other things are coming in, higher rates, what's happening with student loans. You put gasoline on top of that, that's a problem.
And we're going to sort of suss all of this out over the next 2 hours in relation to Europe as well as the U.S. So ECB President Christine Lagarde just wrapped her news conference. Here's what she said when asked if the ECB was done hiking rates.
The focus is probably going to move a bit more to the duration, but it is not to say, because we can't say that now, that we are at peak.
Joining us now from Frankfurt is Bloomberg's Maria Tadeo. Maria, the mood felt gloomy. What was your takeaway?
Look, it sounds gloomy, of course, when you have the numbers that, of course, they presented today. This is an economy that clearly is facing real downside risks that are not just manifested in the future, but they're almost palpable now. When it comes to that decision today that was announced, it is a hike. The market, remember, had been almost repositioned over the past week to now count this hike. She said, I don't want you to think the mood in the room was antagonistic. That was her word. But, of course, you know, you can decide whether you believe or not it was antagonistic inside, which she said, however, is that this was not a consensus decision, but it did bring about a solid majority. I think to me what is interesting going into this meeting, of course, they delivered on this hike. Is the 10th consecutive. It built on this very aggressive hiking cycle from the European Central Bank. It's interesting that the initial take was that is it. They are done. And then in that press conference, she perhaps added a little bit more nuance. She was asked 2 times, is this it? Are we done? And referred to a number of things, including a theater play that perhaps kept the way open. But it's also interesting that then she hedged it again by saying perhaps the focus now is on duration. So you could argue, yes, maybe this is it, but she can't make it that explicit.
She doesn't even want to talk about the words cut. She doesn't want to use that word yet. And this is the problem, isn't it, Maria? If she says she's done, the next thing that happens is the market price is in cuts. She doesn't want that to happen. Therefore, she can't talk about the fact that they are done, but she's kind of signaling that they are.
Look, I would agree. You know, this is a question of how explicit do you want to go, knowing that potentially the shift could then turn into cuts. You know, or a situation in which they're still hiking. They obviously say they're not done with inflation, and then yet you still get a question on rate cuts. It is a good point because she did say, again, she was asked a number of times about is this the end of the road? Is it a yes or no? Did not give a definitive answer. But in the one area where she said we've not even pronounced this word, the word cuts is not even in the picture, was precisely to that question, but Guy, I would tend to agree on this. The market does believe basically she's now laid out a platform to a pause. Again, maybe not as explicit as some would have thought would come with a press conference like this. She was given 2 opportunities to put this debate to rest. I mean, she was asked flat out, are we done? Said there's a movie play in which a door is opened or closed, but that is a movie play and this is real life. We're in Frankfurt. She repeated again, well, the peaks, we can't determine at this point we're there yet, but again also stress, maybe perhaps now the conversation turns into duration. I think that alludes to your point.
Maria, great work as ever. Thank you very much indeed for joining us from Frankfurt. Inside the ECB, Maria's going to be back in the next hour, continue our coverage. She's going to be headed next to the EU Finance Ministers meeting, of course. That's going to be taking place in Spain. An exclusive interview coming up with the French Finance Minister, Bruno Le Maire. Look forward to that. His reaction to what is happening here. Remember, we're getting a downgrade to European growth. What does that mean for the French economy? Let's take you now to our question of the day, because I want to compare and contrast the data we saw out of the United States today, the retail numbers, the claims numbers, the PMI numbers. Are Powell and Lagarde still on the same page? Does it feel like it? Are they? Carsten Bretsky, ING Global Head of Macro Research and Chief Eurozone Economist, joins us now. Carsten, looking at what Lagarde said today, looking at the US data, do you think the Fed, do you think the ECB are on different tracks right now?
No, I think they're pretty much on the same page. I think they're only communicating differently, Guy, because the U.S. is also in this pause environment. The U.S. economy is also looking to a further slowdown of growth, and that is exactly what we're also seeing for the Eurozone economy. I think de facto both central banks are now in for a longer pause. The only thing is, none of these two can actually say it, because if they were to say it, the risk is high that they miss the boat again.
So then how do you read the U.S. data today? Because you could read it like, hey, you know what? This is solid. It's not as great as it was, but you take a look at July retail sales, the control group, that was revised up by quite a bit. The data's solid. The data in Europe is not.
That's correct. The data in the U.S. is much more solid. It looks as if the U.S. economy is more resilient, but I think that this student loan issue with the repayments starting and kicking in again in September, plus the delayed impact of the rate hikes so far, will still weaken and bring down U.S. growth. And I think, of course, you're right. The U.S. is more cyclical, but it will start to slow down, while Europe is already a bit more structurally weak, which poses a different risk to the ECB. But also when you look at where policy rates are right now, the Fed is clearly higher than the ECB. Both are now very close at peak. So I think they're on pretty much the same page.
Okay. Carsten, which central bank cuts first?
The Fed. Very clearly, because I think the ECB, like Lagarde said, they didn't even pronounce the word cut. The ECB will now really try to keep rates high for as long as possible. So this is the new high for longer. Because if they don't, there is a big risk that it fuels again the inflation, that there might be a second or third wave of inflation. So the ECB is in a high for longer, probably until next summer. If the U.S. economy really starts to slow down towards the end of the year, the Fed will be first in cutting.
So the cut for the Fed is based on the economy actually slowing. Could we, though, be in a situation where the U.S. is higher for longer and the ECB is lower for longer?
Well, compared to the U.S., of course, the Eurozone is lower for longer. But, of course, we could be in a situation in which both central banks are in this kind of no-change policy environment. I think that is possible. If the U.S. economy turns out to be more resilient, if we only have a very short-lived slowdown, then I think the Fed will also be inclined to keep rates where they currently are. If this Eurozone scenario plays out, in which it is only is stagnation, only anemic growth, but inflation slightly too high, then the ECB will also keep rates where they are, and then we could see in a year 2024 without any rate cut by neither the Fed or the ECB.
Why did the ECB hike today, do you think?
Because this is for the team spirit. This is a compromise solution, as it always is. And, you know, if you want to have some fact, but I always say monetary policy is more an art than science. So we can always find figures and data with hindsight. The biggest reason today was that when you look at their inflation forecasts, inflation, even headline inflation, is only coming down below 2% by the end of 2025, by the end of the forecast horizon. And this is far too late. So therefore, the ECB was still not convinced that what they've done so far is enough. And sure, they know they only have one job to do, and this is fighting inflation. So they want to see really at least the inflation forecast for the year T plus 2, which is now 2025, to be below 2%, and not only at the very end of the forecast horizon, but slightly earlier.
Okay, so now that we kind of know where each bank is going to kind of stay and remain for a bit, what does the market care about more? Is it going to be the central bank conversation, or is it going to be what happens on a fiscal and policy level? Rich Clarida was saying, guys, forget central banks, just look at fiscal deficits. There's going to be a lot of support, money coming in potentially with the green transition, et cetera. Like, what do you want to look at now?
I think you always have to follow what central banks are doing. That's, I think, the lesson we should have learned over the last 10, 15 years. So this remains key. The next thing we'll read the macro data, and the big question of whether or not the U.S. economy will slow down, will fall into this recession or not. And then fiscal, but also structurally fiscal issues clearly matter. Like you mentioned, the Inflation Reduction Act remains a big game changer for growth in the U.S., but also for growth in the Eurozone, because it is taking out investments from Europe, moving it to the U.S. So therefore, fiscal policy in the Eurozone will also matter. If we were to see a return of austerity measures, I think we can count on even weaker European growth in 2024 and 2025. If we see this policy reaction with more fiscal stimulus, more structural fiscal stimulus to attract investments to Europe, then of course the European growth story also gets a bit brighter.
All right, Carsten, hey, we really appreciate it. Carsten Bresky of ING, thank you very much. I should point out also, ARM is indicated to open now at $63. Remember the IPO priced at 51. Maybe we're getting a bit closer, 63. What success looks like, though, I think would be quite interesting. All right, coming up, more on the question of the day. Are Powell and Lagarde still on the same page? We're going to put the question to Lori Brignac, CIO and head of global liquidity at Invesco. She joins us next. As we head to break, as I was just mentioning, Bridgewater Associates founder Ray Dalio speaking about why he's sour on bonds. He spoke at the Milken Institute Asia Summit in Singapore.
I don't want to own debt, bonds and those kinds of things. Temporarily, right now, cash I think is a good investment. Because rates were there.
think they'll be inclined to deliver a hawkish pause. They have gotten good news on inflation. Yesterday, a mixed report, but if you look at the underlying trends, core inflation is moving in the direction they want. So I think what we'll see next week is a pause, but an indication that they're prepared to do more. And I would expect them, I think it's finally balanced, but I would expect them probably to get one more hike in this cycle.
That was Rich Clarida, Global Economic Advisor, PIMCO, and former Federal Reserve Vice Chair, speaking of Francine Lacqua, which is a great setup to the question of the day. Are Powell and Lagarde still on the same page? If you have a dovish hike and a hawkish pause, like, are they kind of the same thing? Joining us now is Lori Brignac, CIO and Head of Global Liquidity over at Invesco. Lori, what's your take? Are they on the same page?
Well, they're definitely fighting the same battle. So I think to a certain extent, they are on the same page. You know, we've seen improvement in the inflation number. We are starting to see, you know, growth slowing. But listen, at the end of the day, it's not happening as quick as they want it to. And so they can't afford to change the rhetoric from the hawkish stance that they find themselves. So, you know, we actually think that's the appropriate policy. They're at a hawkish pause, effectively.
How long is the pause going to last, Laurie? Good morning, it's Guy. We talk about higher for longer. Talk to me about the longer.
Okay, so, you know, I think we were probably a little bit outside consensus for a while. And I mean, maybe it's because I've been in the markets for a very, very long time. You know, I remember 7% mortgages and you were happy when you got a 7% mortgage. But having said that, listen, we think that the Fed is pretty much done. You know, if anything, the next move could potentially be a hike if the numbers don't, cooperate. But at the end of the day, we think that they have paused, and they're probably going to be paused until the back half of next year.
So, Lori, Rich Clarida also talked about how the real driver is going to wind up being fiscal deficits now. Like, okay, we know where the central banks are. Now it's really going to be about how much governments have to issue to pay for all the stuff. And by stuff, I mean energy transition, and I mean, at least here, Medicare, Medicaid, and Social Security. What do you think about that?
Well, at the end of the day, it really is going to come down to Congress and the fiscal situation. I mean, you even saw Lagarde mention that in her statement. She said, you know, it's really now up to the governments to find ways to, promote and boost productivity. So instead of just, continuing to print money to pay for, promises that you've already made, let's think about ways to spend money better, because rates are going to stay high, and they're going to stay high for longer. And unfortunately, the fiscal situation isn't getting any better. I mean, we saw $1 trillion in bills were issued in the front end so far this year. There's more coming. It got taken down very easily, but this isn't just about a bill story. It's really about a sustainability story.
Laurie, is the risk still to the upside on yields?
You know what, honestly, I am the front end of the curve person, so, I'm going to be speaking my own book here. But listen, at the end of the day, when you kind of look at the direction of travel, unless spending comes down significantly and or tax receipts go up, we are on an unsustainable path. So when you sit here and look at the supply demand, and I'm getting very technical here, I don't see how rates can go down at this point. I think rates are going to have to be higher, quite honestly.
I mean, we're Bloomberg. We like it. It's all good. And that's basically what Ray Dalio was saying. Like, you're going to have so much issuance that yields are going to eventually get higher, and then you're going to have to figure out, the government's going to have to figure out what they're going to do about it, and so is the Fed, because you don't want to keep paying those rates. So his point is that we like cash for the short term. Are you seeing that reflected in market movement right now?
We absolutely love cash. Again, I'm going to talk my own book here, right? We run money market funds. And listen, I think when you look at money market funds and cash, it's been a tale of two markets over the last couple of years. When the Fed started raising rates in 2022, the retail investor, which actually only accounts for about a third of the money fund industry, retail investors have slowly been moving money into money market funds. They're taking advantage of the higher rates. On the institutional side, they're taking advantage of higher rates, but if you look at the way the institutional market acted in 2022 and even the first part of this year, we actually saw assets go down. Now the regional banking crisis changed that. So we have seen the institutional investors pouring more money into money market funds. Part of that's for a couple of different reasons. Obviously, they like the higher yields, but corporations and institutional buyers have been holding a lot more cash, and we don't really see that changing, quite honestly. And so we think that the trend is here to stay, at least for the next year, where we're going to just see, people holding more cash than they really need to at this point. But I will say from an economic perspective, and I say this frequently, that's a lot of dry powder.
Sure. But you've got to have a reason to get out of it. And at the moment, I think a lot of people are struggling to find that reason. Laurie, what does this mean in terms of the competition with banks? A lot of people have moved into term deposits. A lot of people have moved into money market funds out of the banking sector. The banking sector is being forced to respond. Have money market funds won that battle? Is that over? How do you see that competition continuing?
So, it's interesting. Money market funds and banks, to a certain, we're partners. So again, not all cash is created equally, right? So if you're a retail investor or you're an institutional investor with your core deposits, that is very balance sheet friendly to banks. If you are a corporate investor and you're holding more cash than you need and what they call non-operating deposits, those are not balance sheet friendly to banks. So if you really look at institutional balances in money market funds, a lot of the large banks have their own affiliated money market funds. So as clients were moving out of regional banks and into bigger banks, a lot of that money just went straight into money market funds. And some of this was not just rate related, but it's also balance sheet related. These big banks have to manage these balance sheets. And so even the banks that don't have their own affiliated money market funds, they have these very large money fund portals where they encourage institutional investors, listen, you can keep a certain amount at the bank, but anything above this amount is better suited in a money market fund. And that's where the rhetoric that you hear a lot is money funds versus banks. In some cases, like on the retail side, to a certain extent, you can make that argument. But when you really see the large flows and the big flows, that's institutional money. And it's all about how do you calculate, how are you capturing that money? Is it operating or non-operating deposits? Makes a big
Laurie,
difference.
really great to catch up. Honestly, that was such a fascinating conversation. Please come back again soon. Laurie Brignac, CIO and Head of Global Liquidity, joining us at Invesco. That money market fund story, listen to what Dalia said. I remember at Davos when Dalia said cash is trash. Things have changed. Anyway, we're going to talk ARM next. This is the big story of the day, indicated to open at 63. We're going to have the latest next. This is Bloomberg.
It's 7:24 on the West Coast. Want to get to the startup where we cover all the top tech stories from the Bay Area and beyond as Silicon Valley starts this morning. But let's be honest, the action is here on the East Coast in New York, in Times Square at the NASDAQ. Bloomberg Technology co-host Caroline Hyde joins us there. Okay, ARM, we're pricing, we're getting there. Where are we here?
Oh, the indications are for a pop, a big one, up to 25% at the moment. So remember, they did price it at the top of the range at $51 per share, but they're leaving money on the table because they need this IPO to go well. Largely because, of course, Masayoshi Son, SoftBank still holds 90% of ARM. They're only listing 10%, so they want to continue that galvanization of excitement around AI, around this particular name being more valuable in the future, should they want to offload it. But Alex, this is so important for everyone else who wants to go public. Just think, right here at the NASDAQ next week, we could be getting Instacart. You've got Klaviyo eyeing over at the New York Stock Exchange. But then got Churro, so many other tech-related names and others like Birkenstock. They want to go public. They want to get into the market. They need this IPO to go well.
Can I come back to the SoftBank issue, Caroline? They have this highly rated paper. They can then use it. What are they going to use it for? Is this what this is really about? This is about the ability of SoftBank to leverage those stocks, to use them as collateral, to continue to fund other things.
Well, isn't it interesting that ahead of the IPO, of course, they used ARM to be able to raise loans, testing some of those banks that they ultimately gave the IPO to. So yes, they want to be able to be using this to, of course, be able to build out the AI vision of Masayoshi Son. Remember, this is a long-term commitment from him, that he believes in a future that is powered by chips, by artificial intelligence. So maybe that's why he decided not to sell as much as he was originally to. Remember, the idea was they were going to raise up to 10 billion. They were going to be selling off about 10%. They actually, well, more than 10%. They actually just decided to only sustain and hold on to a large part of ARM. But it is interesting as to whether or not also this is a proof point in the Vision Fund. Remember, Vision Fund, they bought the rest of ARM from the Vision Fund. It's been down, what, 30 billion this year alone? They need to show success in some of the bets that they've made.
Caroline, great stuff. Looking forward to the first pricing. Caroline Hyde. You can, of course, catch Cara on Bloomberg Technology. That show up in around 90 minutes' time. What are we going to talk about next? The US consumer is resilient in August once again. We're going to talk about it. It's amazing. It continues to be amazing. This is Bloomberg.
Authority.
We're about an hour into U.S. trading session. You're looking at stocks on the upswing. Yields, though, inching their way higher, though, as well. Abigail, do a little tracking the moves. Abby?
It'll be interesting to see if those yields going higher pressure stocks at all, but not right now. We do have this economic data that's perceived as Goldilocks. Just right, those retail sales coming in solid above, but not too much to have fear that the Fed is going to have to hike all that much more than what is expected right now. You can see the Russell 2000 leading the way, up 0.9%. Yesterday, this small cap index closed below the 200-day moving average. That could be a bearish signal because typically these small cap stocks, the growthier stocks, the domestically based stocks, they can lead, especially in big market cycles, both to the upside and to the downside. New York crude, though, this is bullish right now, back above $90 per barrel, the first time that we've seen this since June of 2022. So really following Brent crude up 1.8%. This is bullish right now because it is a risk asset. It confirms the bullish risk on mood we have. If it continues to creep higher, it could be a different story. As for that Russell 2000, take a look at this crazy range that small cap is in this year, really underperforming large cap to a small degree. There's the close below. We're back above. There is a bearish congestion pattern in here, though, that suggests very likely we could see the Russell 2000 go back down towards its lows. If that's the case, you have to wonder what's going to be ahead for not just the economy, but large cap. Speaking of large cap, let's take a look at some of the chip stocks on the day. The stocks up just slightly, NVIDIA up slightly, and then two of the companies that are direct competitors to some degree. These actually make chips, Advanced Micro Devices, Silicon Laboratories, semi-cap equipment company. A little bit of pressure. This, of course, ahead of the ARM IPO, ARM trading publicly. It is priced, of course, at $51. The last indication I saw, $63. That is, of course, a 23% premium. They make, as you know, the circuitry that goes into the chips. It's going to be really interesting to see how strong this IPO opens when it does open. Give a really good indication for next week for Instacart and other companies, not to mention technology next year after this drought we've been in for IPOs.
It's amazing. We had to rethink, or remember how to do all these IPOs. It's been such a long time. Abigail, we're all on tenterhooks. Thank you very much indeed. We'll wait for that ARM pricing. Let's talk about U.S. retail sales. They come through.